You're listening to A Book with Legs, a podcast presented by Smead Capital Management. At Smead Capital Management, we advise investors who play the long game. You can learn more at smeadcap.com or by calling your financial advisor.
Welcome to A Book with Legs podcast. I'm Cole Smead, CEO and portfolio manager here at Smead Capital Management. At our firm, we are readers, and we believe in the power of books to help shape informed investors. In this podcast, we speak to great authors about their writings. The late, great Charlie Munger prescribed using multiple mental models and analysis. We analyze their work through the lens of business, markets, and people. Today's date is September 29th, 2025. This is our quarterly book list where we talk about books, and yes, more books. Hosting this with me is our founder, chairman, and chief investment officer, Bill Smead. Dan, thanks for joining me today.
Great to be with you.
So let's start out like we usually do. We'll talk about what we've recently read. I'll kick it over to you, Bill.
Yeah. What I wanted to do is I wanted to crawl back in a couple of different time periods that I felt were the most analogous to today.
Okay.
We've had a tremendous success story in investing with eBay, and I went back and read the book about what happened in 1997 through 99 as they were funded by Benchmark Capital. It's
okay.
Really the book is about Benchmark Capital, but it really is wrapped around the story of the public offering of eBay and the process that went into it.
And what's the book title and author?
E-Boys by Randall Strauss. And so that dovetails with the one I'm reading now, which is Brooks Golgonka.
Well, we're not going to go into that yet.
Yeah. But anyway, but the two of those cover a time period that I felt I had to understand more because of the way it relates to today.
Let's see. For my books that I recently read, let's see. And some of these were on the podcast, so I'll just mention a couple of these in passing, but I want to comment on some of them. Meltdown by Duncan Maven was a great read. Obviously, he's written a lot for named publications. It's the story of Credit Suisse. Bad banking is always fashionable. That would be like my very big takeaway from that. Let's see. Anointed by Toby Stewart. I'd never thought about this. As I hinted at Munger in our opening, like I usually do. Like we always talk about like incentive structures, and Munger talked a lot about incentives, right? Incentives drive everything that causes you to get up in the morning or not. What I hadn't thought about, and I think this is so good. So we think about like, let's say in society there are celebrities, okay, and people would be like, well, it's not good that we look at those celebrities and want to do things they do. But he actually made the best economic argument for that, in that people you watch, or what he calls the anointed in his book, are people that actually save you time in making decisions. Because if they weren't people you followed, what would you know to go shop for?
Right. Well,
you'd actually have to make more decisions. So, for example, he gave the example of Coco Chanel and the idea of like the little black dress. Every woman has a little black dress nowadays. Why? Because Coco Chanel made that fashionable. And what that does is it makes your decision quicker. And so now it makes someone to go into down the question of like, well, what's the difference between a fad and something that's timeless? That's a whole nother discussion, because there are things that you might do in a season that becomes a fad that it's not timeless. But the more timeless things that show up in this, you could see where someone says, well, I need this because in that occasion I need this, and things like that. Like, for example, I wear a seersucker because that's a timeless thing, and someone else I saw did that, and therefore it's one thing I don't have to go out and decide on. And so he really presents the idea of efficiencies among the anointed as being a dominant driver for you to decide what you do day to day and in your decision making, which I thought was a very interesting way, because it saves time. Is really what he argues?
It probably speaks some to leadership also. In other words,
well, no, because it's more so that we have to anoint something. It has little to do with leadership, but like every sector of the economy needs to have an anointing in some way, shape, or form. And it happens, like, and he even takes it into like a biblical context a couple times in the book where it's like everything's got an anointing. And I think it's weird to actually think if there's a group of people or, I'll call it a part of business that's not anointed, that would actually be the oddity. And that's really the case he makes in the book. Let's see, a couple others. The Money Trap by Alok Sama. Alok was at SoftBank. He's a former banker. Very enjoyable book. Also, again, to your point, thinking about the kind of season we're in. Alok and we had him on the podcast. We talked a lot about, does this all make sense or how he had to adapt coming from the banking world. Other books, I'll just mention Plato and the Tyrant. If you like the classics, I would highly recommend you go into that. Imperial Standard by Graham Taylor. If you want to learn about like the origins of things like steam-assisted gravity drainage, which is what you see in like the oil sands, for example. You'll see that in the book. It's just a great history of Canada. And then probably one of the more controversial books of the last 6 months, The Once and Future World Order by Amitav Acharya. He makes the case that the world as we know it will not be dominated like the former world order of the past. Okay. And I'm not saying he hasn't made that case before. If you look at his other writing, he's made that before. But he really argues that the U.S. dominance structure is going to end. Now, he's not necessarily pointing to the fact that means the United States will end as a power. But he presents this idea of other structures. And I think he also critically says, like, do you really want China as part of that structure? And have they done that well over centuries? So it's just a really interesting way of looking at it from another picture and kind of outside of what I'll call like financial markets and the idea of dollar dominance and whatnot. So let's pivot. What are you currently reading?
Well, this Once in Golgonka, it kind of dovetails with that book I read a while back that told about the Florida land bust. And
who writes the book?
This book is John Brooks.
Okay.
And what I wanted to do is I wanted to step back into the late 90s investment market-wise with something that's not directly related to our common stock picking, but to understand the emotion and the attitudes that people took in the excitement of the dot-com era. And now I want to go back into the 20s because we know that there was a terrible land bust in Florida, but the stock market crash of 29 gets a lot of credit for ushering in the Depression. And all I want to do is get as much feel as possible for how much the current mania for various aspects of the stock market are going to impact what you'd want to be doing and not want to be doing.
Sure. What else you got in your list?
We're all reading Pilgrim's Progress, which is a great book, by the way. That one that Cole had to do probably what grade in school?
Many years ago.
And then my wife and I have been doing the audiobook of the Book of Psalms, which just walks you through 3 or 4 of the Psalms each day to kind of get your thought processes heading in the right direction.
Yeah, to your point, what I like about Pilgrim's Progress is it's so timeless.
Yeah.
The timelessness of the book and what people go through and what whether yourself or other people, et cetera, the doubts and the problems that come with it are again very timeless. It's just to give people a feel. I think the book was written in the 17th century. Obviously, the Protestant Reformation took place in the 16th century, 1517, if I remember correctly. And so it's just interesting to think about to read a book, from 16 whatever. And 400 years later, roughly speaking, it's very appropriate.
Still pertinent.
Very pertinent. I kind of consider Pilgrim's Progress a pillar of Western thought because of its already made it 400 years, and it seems to be pretty applicable to 2025. Let's see. The book I'm reading is called another book I'm reading is called Inflation: A Guide for Users and Losers by Niccolo Fraccaroli and Mark Blythe. This is some book I came across in the Wall Street Journal, and it's interesting. They're really trying to paint inflation as a multi-factor model, which I think we would all agree it would. And their main question that they attack, which I think is different, is who are the losers and who are the winners, which I think is an excellent question because as I think back, and they talk a lot about the post-pandemic, if someone said, who are the losers in the post-pandemic, world? I'd say, well, the losers were capital for the first 2 or 3 years, right? The inflation-adjusted returns were low, and the winners were labor, okay? The winners were labor. So that was the loser in the prior episode of heightened inflation. And I think it's an interesting thing to think about who are winners and losers. A, because of the environment. B, look at the average age of investors. It's pretty old. It's more likely a gray-haired person. And so it really makes you think about, on one level, someone could say, well, you're kind of debating class warfare. And it's like, well, yes, but it's not uniform. Not everyone's affected in the same way. But there are winners and losers in every episode. Like if you have low inflation, many people would argue during low inflationary periods, labor lost big time. Now we could debate the finer points of that. But again, I think you just ask the question of it's like Newton's third law. For every action, there's an equal and an opposite reaction. And the question is, who is the opposite reaction of inflation?
Yeah, well, governments that have borrowed money are a big winner in inflation. Because they pay back the money, they're actually paying back way less than they borrowed. In other words, $1 billion that depreciates by 50% over 20 years is.
Well, yeah, if you have long-term debt, if you got to refinance it at short-term rates, you could get screwed.
Well, no, but we have a huge amount of federal government debt to pay off, and if inflation goes up 5% a year for the next 15 years, you're going to pay that money back, but those dollars are going to be worth 40% of what they are today.
Yeah.
So you get a bargain. Inflation is the bargain of the person that borrowed the money.
Let's pivot to books you've had recommended to you.
I was this Guy Speyer's book, a very successful portfolio manager. The Education of a Value Investor has been recommended.
Let's see. I have a couple. I'll mention also, just to make sure I don't misquote him on this, but Superfan Steve sent me across some books that he's been in, and one of them is actually one I had on my list too, but he's got Manics, Panics, and Crashes by Charles Kindleberger, who we did the book about, Kindleberger, which was a very fun read. He also has The Warrior, Raphael Nadal and His Kingdom of Clay by Christopher Clary is another book I see here. His other book that I actually have on my list too is Born to be Wired by John Malone, which is his biography that he's published. His autobiography he's published about his career and story, and those have been out there as kind of big talked about books. Let's see, two other books, and they have nothing to do with each other, as you'll probably gain. They All Came to Barney's by Gene Pressman. We like studying the history of businesses and whatnot, and so just understanding what made Barney's.
Yeah.
Just as an example, we own Macerich. They own a property down the street here called Fashion Square. It's the big mall of Arizona, if you will. And there used to be a Barney's there, and there's now an Apple. And so thinking about what made Barney's tick, what made that work, what made it decline. I think those are really good questions to ask. So I saw that book title out there, made me want to look at it. The other book, Amy Coney Barrett has published a book that just came out last week called Listening to the Law. And so just another book that, caught my attention and looking at. Let me pivot. So we always ask a couple questions towards the end of our book list that I want to bring out. So these would be kind of too open-ended. How do we, this is a question we get a lot of, I think, how do we look at the CapEx spending of AI that is currently going on? What would be your take and view of that, Bill?
Well, it's a space race is the way I like to think of it. And back when we were in a space race with Russia, it's amazing to think back about how much that influenced our attitudes, but it also caused a lot of interesting technology to get developed. The willingness of two countries to just pour massive resources into that for only really to say that they were the one that did it. I mean, later on we participated together with them on some space related stuff.
Yeah,
and so that's where I'm at.
Okay. So I think the things that jump out to me on the question. So, and we're doing some work on this. This is for a talk I'm doing this week, but it's a talk that I'm going to do at our Investor Oasis. Is my plan for kind of a bigger talk on this. Is we look back at, and there was some data. Paul Kodrowski out online had posted some of this, so I appreciate him sharing this information. But he had showed what the CapEx to GDP was of the railroads in the 1880s.
Yeah.
So I was like, okay, that's a good data point. There's a couple other studies that look back at the CapEx tied to telecoms in the late 1990s. And what I find really interesting, and this might be the game, just so everybody's aware, I think this might be the game. But we're right now, if you look at the level of CapEx among the AI hyperscalers, it's at the same level as the telecoms were in the late 1990s. And obviously, like as you watch Zuckerberg sit down with the president, he's like, like 600 billion. And then he turns to the president and said, I didn't know which number you wanted, right?
Yeah.
So I say that because
Lucent was the...
let me finish. Let me finish. So we're right now at the level of CapEx that has been historically significant, is what I think about. And so again, and I'll give I'm going to throw out some props to some various research groups out there. So in the 1880s saga, if you go look, Barini Associates, they provided us some interesting work on the oldest stock index out there that people reference is what they call the Cowles Index. It goes back prior to the creation of the Dow or even the S&P 500. And the Cowles Index, is effective from 1870 on. And Barini did some work on tracking the railroads from 1870 to 2000 off of this work. And it kind of reminds me of like the stocks of the long run argument where Siegel was like, see, if you bought at the top of the Nifty 50, you almost outperformed the stock market the following 25 years. And it's like, that's cool if I'm an academic, but you're in my job. Like, we can't do that because we'll get fired. So if someone like walked in 1870 and said, listen, there's going to be a boom in railroads. We're going to do, railroads going to be so important to America. And 130 years later, you're almost going to beat the average stock.
Yeah.
It's like 130 years later.
Yeah. Well,
so that's it's historically significant. I'll let you go on with what you were going to say a second ago because I'll come off of that.
Yeah. So in '99, Lucent became the 7th largest cap company in the world.
Yeah.
And in the year '99, half their revenue was selling equipment for people to provide the Internet of Things, and because the Internet was going to change our life, was borrowed from them. They
provided credit.
They provided credit on half of their revenue, and of course that collapsed, and Lucent collapsed.
Yeah.
So just think about it. They went from being the 7th largest cap company in the world, and that brings me around to why I'm so interested in these two books to connect these two time periods. Here's my concern about today, and I know I sound like an old fuddy-duddy to say this, but the stock market and the wealth that's owned and the behaviors of the people that own the common stocks in the United States is more powerful than any of those two prior junctures. In other words, it was one thing for the dot-com bubble. I just read the part where eBay stock has now gone from, being priced at, say, $20 to $648 in 2 years. That was owned and participated in a narrow group of people. It wasn't widely dispersed through all the economy, but just the same, it caused the stock market to be a total disaster.
But it's the closest analogous period to today.
It's the closest analogous period to today, but the difference in 1929, only 1.5% of the population of the United States owned a common stock. In 1999, lots of people owned common stocks, but nowhere near as importantly and spread as wide as it is now with 401k plans.
Well, but if you look at the household net worth by the St. Louis Fed, it's 5% different as a percentage of net worth.
The common stock?
Yeah. The equities as a percentage of household financial assets. Pardon me. It's 5% higher than 99, which is the highest it's ever been.
It's highest it's ever been, but more important, it will be more closely tied to the psyche of the consumer than it has been before.
Correct. But consumer of the owner, which the owner is a boomer. Hi, I'm Cole Smead, CEO and Portfolio Manager here at Smead Capital Management and host of this podcast. If you enjoy this podcast, I'd like to invite you to check out SmeadCap.com. At our firm, we are stock market investors. We advise investors who play the long game with a discipline that has proven success over long periods of time. Learn more about our funds at SmeadCap.com. Past performance is not indicative of future results. Investing involves risks, including loss of principal. Please refer to the prospectus for important information about the investment company, including objectives, risks, charges, and expenses. Read and consider it carefully before investing. Smead Funds distributed by Smead Funds Distributors, LLC, not affiliated.
There's other things connected to it, though, that didn't exist in 99 and didn't exist in 1929. There was no passive index investing of any meaningful amount in 1999.
Correct.
Right? That's all come to pass by...
well, the original advocates of that were like Motley Fool. They'd say, like, go buy the
Motley
passive
Fool
index.
and Jack Bogle's development of the S&P 500 index for Vanguard. Well, today, there is a whole religion around accepting that fact, providing participation at the lowest possible cost under the assumption that the market will never have a long enough period of doing lousy to punish people for doing that.
Yeah.
And the problem is that 1929 to 1941 would have completely destroyed that. And 99 to 09 did a pretty good job of backing it off. And so it'll be interesting to see how far this one gets backed off.
When if you look at the concentration of the stock market, historically, again, you went from railroads in the late 19th century to industrials being the dominant feature of the stock market. So like what really got drubbed in the 20s would have been industrial style, like the RCAs.
Well, Ford was a glamour stock in the 20s.
So I say that because I don't think about it the same way, because ultimately it's where's the problem? And the problem's actually not that broad. When I say, if you look among the constituents, it's not very broad. There's a lot of losers among the constituents. To your point, the dollar-weighted nature is risky.
Well, the multiplier effect on this spending is dramatically higher than the multiplier effect on normal spending.
I don't necessarily agree with that.
There's 10 cars parked at the brand new house being built in our neighborhood each morning. Okay, and I can tell you that.
But that's among, again, winners and losers. That's among wealthy people.
But the 50 to 80-year-olds have become wealthy in many cases.
Agree,
because
but they don't drive consumption in the economy though. They are the least consumptive compared to, there's like, I say it because I'm 41 years old. I am the consumer.
Yeah.
I'm roughly the consumer. I'm not a perfect picture of the consumer, but I'm the consumer from an age perspective. And yes, to your point, am I likely to, as an age group, is my age group likely to be involved in the stock market? Yes. At the same time, is this the first time we've had degenerate 40-year-olds gambling in the stock market? No, we had that in 1999.
This, they picked on Reagan because he called it trickle-down economics. There's more trickling down than we've ever had. And it's my opinion that will be a big problem at some point in time, because if the thing that, like you're using the CapEx with the AI, anything that breaks the back of those 10 or 20 largest cap companies is going to break the back of the S&P passive index for an extended period of time.
The only problem is it doesn't line up with the labor, because if you think about the average constituent, they're more likely to align with the labor, right? So like if you're working at some 2-bit bank that's publicly traded, wherever in the country, that's where more of the labor sits, is in smaller businesses.
Yes.
So and they're starved for capital relative to these things.
But
so in other words, like if let's say the big things do poorly, that doesn't hurt everyone, and the dispersion of capital is actually what's needed for the average laborer.
Well, I'm glad you're an optimist, because we need to be optimists. What I'm saying is that if you look at history, there's never an
Well, I agree, but here's an example. Nortel was part of the same Lucent game. They provided credit.
Yep.
If you look at the CapEx of telecoms, it went from 120 billion to less than 60 billion within 2 years. So again, to your point, the stock market's not very good at predicting CapEx, future CapEx. They really suck at it. Sorry, Mr. Market. I'm here to offend you. They suck at predicting CapEx. Nortel was bankrupt and closed within 9 years. Yeah. So now, did that matter? No, it didn't matter.
Well, when it's $6 trillion companies,
it was
it'll matter.
$180 billion business then. That was one of the $1 trillion sized companies at the time.
I understand.
And with nine years, it didn't matter.
It will matter if it hits the Magnificent Seven. It's going to matter. Yeah, immensely.
So beyond that, what do you think? What do you think the market has the most wrong on? Like outside of the AI, CapEx, big company thing. What do you think the market's most wrong on?
Well, you and I agree on this. The inflation subject is the one that I go to McDonald's with a grandchild, and what used to cost $12 is $25. And I don't know how they get the inflation statistics they're providing, because that's as basic in our society as just about anything. What the fast food places are charging, which is a function of they have a hard time finding good labor, so they're having to pay more and more for good labor, and they're passing that cost through to the customer. So that is that's the other thing that makes it kind of interesting in relation to, like, say, coming off the go-go 60s, was the inflation caused people to want to pay a lot less for future earnings than it used to. Yeah, and
M2 is like hitting a new high right now. I agree on that. Here's what I think is the most interesting thing. I think we all know the human bias is towards negativity, just naturally, okay? And what I think is interesting, so use 2025 as a year to date. I was doing some of this mental accounting, okay? So you're in the spring, everyone's just like, holy crap, we got a deep recession on our hands. Now you come out, and what's their bias now? Oh, the labor market's weakening, and we got this economic problem. I actually think that parading around on economic weakness is a problem. And I say that because, to your point, it's when I hear it from people in the investment business, they're like, oh, the marginal person, and they're doing so badly. And it's like, okay, show me a single time in my career where someone's gone out and bragged about the low wage. It's never happened. It's never happened. So hearing someone say, oh, the low wage is doing so poorly and they're right on the edge, and all, that has been said every year for my almost 20 years now in the business.
That's chronological snobbery is what it is.
It's cool. Yeah. They're easy to pick on because they're not on the upper end of income or wealth or whatever. Okay. So, but here's the catch. I do know that person's getting more assistance than anyone because they're spending 7% of our GDP in deficit. Okay. And if I was going to go out and say, who's getting the most benefit right now that's in that lower end, it's actually a retired boomer who's in the low end collecting Social Security and getting Medicare, for example. Yeah. That's who's actually getting the biggest fiscal benefit as we speak. And so I look at this all together, and I think preying on the economy, to do poorly, it will not be the knock-on effect. Because again, back to winners and losers. Let's say inflation perks. In the last bout of inflation, unexpectedly, labor won for 2 to 3 years.
Labor won for
easily.
Easily.
Okay.
Easily.
And so it's like, okay,
the dock
labor
workers,
wins,
the machinists,
and we can't quit spending our money from a federal perspective, and it's very unpalatable on either side of the aisle. That does not add up to have this weak economy. Now, inflation, that's a whole separate subject, but weak economy while the stock market falls off. And then to boot, among people who are going to get hurt that don't own any assets, supposedly, that just doesn't all add up. I think the institutional bias is that it's they like betting and talking negatively about people on the lower end of the income spectrum. Also, political pundits will use it to their advantage of saying oh, you've never been bettered off or whatnot. That's not true. 93% of those people go off to higher income thresholds in their life. And so I just think it's an easy whipping boy. It's easy to be negative on the economy. And if you think about it, let's say you invert it back to Munger's thinking. It's like our entire industry is made to sit around and try and figure out where recessions are coming from.
Well,
rather than sitting down and saying, okay, recessions are going to come, but again, who are the winners and losers of the next recession? to use
you know my favorite thing about recession.
Well, I agree, but I lived in Seattle in 2000, and there was a deep recession in Seattle.
Yeah.
2000 to 2003. I remember sitting in the Lincoln Mercury dealership with you, the old one that's now where Amazon's headquarters
Ralph
are.
Grossman.
Okay.
Yeah.
And a gentleman that was sitting there had just graduated from Seattle University, and he was saying, he asked you what you did and whatnot, and he was, he's like, oh, I'd love to get a job in the investment business. He was talking about how tough it was to get a job at the time. Okay, well, okay, what did the stock market look like in 01 or 02? Pretty crappy. Yeah. How did the economy of Seattle look like with the stock market doing bad? Pretty crappy, okay? But if you weren't in the Bay Area or Seattle, it wasn't that bad.
Yeah, if you weren't directly affected by tech.
Correct. If you were in New York, how bad was it? It was bad.
Yeah.
And so,
well, but
I think that's the chronological snobbery. If you hurt tech, if you hurt New York, you've just ruined the U.S. economy, as though we have major portions of our labor sitting in the beneficial areas.
Yeah. So if a recession is defined by a contraction in the economy of, say, 3% for 6 months. Or a year.
Just 2 quarters or more.
2 quarters or more, right? So what I tell people about recessions and what you should or shouldn't do with common stocks based on that is, if your spouse loved you 3% less next year, would you divorce her?
And the answer is investors would every time.
And the investors will divorce their stocks because of that. And the answer I give is, when you've been married for a long time, if your wife loves you 3% less each year, that would be a big victory.
But like, for those of you that have been married a long time, I'll give you here's another way of thinking about it. I think our industry is set up in such a way where it's like a spouse who's waiting for you to do something wrong and be like, see, I told you. Because it's like, I mean, again, all the reports are like, oh, the JOLTS number and the labor numbers and this and that. They're all sitting around saying, see, I told you. It's getting worse. I told you. I knew you were going to do that wrong.
Yeah.
And it's like they're sitting. So it's like Wall Street's job is to sit like the espouse to the economy and tell you, see, I told you were doing something wrong. When they don't sit around in the stock market right now and say, see, Oracle is showing numbers that are a good story in a quarterly earnings call, but the fact that deferred revenue is not going up means they might be lying.
Yeah.
But that's the new boyfriend.
Yeah.
Oracle's the new boyfriend. The economy is who they're married to.
Yeah.
And so I think a lot about that. I'm blown away at how much time and effort is spent around criticizing the economy. Again, go back to the spring. Lots of criticism. Fast forward to today. How much has changed? Some, but not really anything of meaning.
We pulled out a chart the other day, and the best time to buy home builders is when home builder industry sentiment is low.
Correct.
And the worst time to buy them is when they're all excited about their industry. And that's why psychology is such an important thing in common stock investing.
Well, I agree. And as we've seen over many years, the thing that people ask us the most questions on do not end up becoming very important because they're well perceived. It's just like right now, Fed's meets this Wednesday. Does everyone and their brother think the Fed's going to cut? The answer is yes.
Yes.
So how are markets pricing that in? The answer is they already are.
They already have.
Which means the market's actually already relaxed its liquidity in advance of the decision, which means it's not important because the market's already easing because people wanted to get ahead of the change.
Yeah. The 10-year Treasury's down to about 4%.
And it got me thinking about this because, again, so we think of like indexation. I'll give another example of this in markets. So in indexation, there are hedge funds and groups of investors out there that try to predict the index changes, okay? So we have a company, Strathcona, who entered some of the indices recently. And you'd figure, oh, man, if that goes in the index, the stock's going to go way up. No, the stock went up weeks in advance.
Yeah.
Because someone was arbitraging what was going to happen in the future already. And so by the time these events happen, if everyone thinks we have a weak economy to come, and it comes 2 years later, it's already priced in many cases because they all pre-planned, predicted, and pre-priced it.
Right.
And so in that case, shares traded on the day of indexation. What happened? Price didn't change.
But if you own the entire stock market, if you own the Wilshire 5000, as Buffett used to talk about, it's a bigger factor. And virtually the stock market has never been this concentrated.
But the stock market's never had more of its revenue come from outside the United States too.
Yeah, that's right.
So it's like it's concentrated, but if you look at the most dominant companies in that concentration, they are roughly non-U.S. businesses.
Yeah.
So again, that makes the least amount of reason to attach to the economy because the revenues, to your point, are concentrated outside of the U.S. I mean, to your point, I mean, this is one for the ages. There's no question about that. But again, back to the question on the book I mentioned with inflation, like who are the winners and who are the losers? And I think that will be the most interesting thing. Again, back to market perception. The market's already perceived who the losers are.
If you're a skilled laborer, the world is your oyster going forward. If you're a skilled laborer, right? If you're a tradesperson, if you're a dock worker, if you're a machinist, if you've got a strong union, you're in the driver's seat.
Well, and someone brought this up the other day on X. They were talking about people on their apps trading stocks and whatnot. And I mean, you saw this. The idea that, again, I'll use my own age. Like the idea that a 41-year-old wakes up today and is like, I don't need a job. I can just trade at home in my underwear or whatever. Did that go on in 1999?
Well, no. They have two occupations similar. They're betting on sports games and trading.
Well, yeah, that's the way they've improved the model. Boomers could only bet on the stock market in 99.
They can only bet on the stock market.
Now
they can only trade options and lose their money.
Yeah, now they can trade. They can gamble in multiple places.
Oh, I mean, you just watch the sports broadcast. The whole sports broadcast is built around facilitating the gambling that people are doing as they watch the games play out.
Well, yeah, and it gets back to the old Willie Sutton line, like why do you rob banks? Because that's where the money is. That's ultimately what they're following. I think back, kind of as a last parting thing, it was the Ameritrade commercial, and it's got the redheaded kid who was in one of the Nickelodeon shows, and he goes to the old guy, and the old guy, kind of a slightly overweight gentleman, probably 30 years his senior. And he's like, hey, Mr. Such and Such, you coming to the party on Friday night? Yeah. And he's like, I don't know. He's like, come on. You know, like gets him all riled up.
And he went to the copy machine and put his head on the copy machine to make invitations with the picture of his...
He called him Mr. B. I think he called him Mr. B.
Yeah.
And he's like, yeah, I might come to the party.
Light the candle, he told him. Yeah, light the candle.
He's like, you going to buy another 100 shares? He said, let's light this candle.
Let's light this candle.
And so that was the same iteration of what we see now. It's just, again, it's a different person. And here's what I love is you don't run into people. You'll never see this. You don't run into people who tell you, oh, by the way, I ruined my net worth for about 5 years in the .com bust. Why? It's just not fun to say. It's just not fun to say. So I find it really interesting to think about this as a practice where it's like, okay, tell me what you think today and tell me how bad you did 2003. If you're willing to tell me that, then I might be able to judge what the manias are or how you deal with manias because you got to get the big things right.
Yeah, I was reminded in reading the E-Boys that in my separate accounts that I ran from the prior 4 years to 99.
Under predecessor firms.
Under predecessor firms, I had made about 20% compounded. And by the end of 99, some of the people I worked for were firing me because they were getting new IPOs that doubled the first day from another entity or another stock brokerage firm. And that, you just knew it was just the height of insanity.
Well, and I mean, if you think back, like I remember the bottom in 2009, it's like nobody cared.
Yeah.
Nobody cared. Nobody cared about stocks.
There will be a bottom of 2009. There will be a 1981. There will be a 1941.
Well, correct. And the difference is, and I remember your buddy Gil Schroeder.
Yeah.
Gil said I think he said at the peak of the Nifty 50, people would get to the brokerage firm before they opened the door, waiting in line to get their trades in.
That's right.
Okay? And I say that
30
because
people in line at the brokerage office in Seattle to get a chance to buy stock in the go-go 60s.
And the difference is you don't even have to go wait at the door.
Yeah, no.
You just go on your phone.
It's on a handheld device.
Yeah. Bill, thanks for joining me to share with podcast listeners what is on the Smead book list. For our listeners, if you have a great book that you'd like to recommend, you can email us at podcast@smeadcap.com. That's podcast@smeadcap.com. You can also reach out to us on X. Our handle is @SmeadCap. We'll give you a shout out in the next quarter like we do for Superfan Steve. Thank you for joining us for the Smead book list on a Book with Legs podcast. We look forward to the next episode.
Thank you for listening to A Book with Legs, a podcast brought to you by Smead Capital Management. The material provided in this podcast is for informational use only and should not be construed as investment advice. You can learn more about Smead Capital Management and its products at smeadcap.com or by calling your financial advisor.